Hi, Akiva. It's V, Karen, everybody.
So while we're waiting, I'd like to say thank you to the many of you who keep sending positive feedback about these lectures. It's very heartening. It helps us keep going on the assumption that this actually does deliver value and that it's hopefully providing clarity for those of you who are new to the industry or maybe already in the industry and wondering about those parts of the industry that are less clear. So keep the feedback coming is another way of saying it. And I guess you all know by now, but these lectures are posted on the Bank of Israel YouTube channel, as well as the Gershon Fintech Center at the Hebrew University. So if you want to go back and refer to something or refer a friend who you think might be a friend or colleague you think might be relevant, of course, please feel free. I see some familiar names on the screen that weren't with us before, so glad to have you. I don't know. Should we wait another couple of minutes, Ophira? What do you think?
No, I think we're going to start.
Okay, let's kick off.
Just a moment. I'll send in the chat, so you'll have already the link also to the previous lectures. You can see it. I shared it in the chat. So the two previous lectures we have there. And Oded, this time we're going to have the second part of the previous
lecture, yes. Okay. It ended up being longer than expected, and so we said we would complete it this time.
Okay.
And
then the second one, the next one will be the cryptocurrencies, right?
Yes, digital currencies.
Digital currencies, sorry, yes, of course. And we're going to add another date for the 5th.
Yes. Right? So basically, we're going to do one today, another one 2 weeks from now, and another one 2 weeks after that, on the assumption that I am able to get through everything I want to get through. Based on the feedback, if I end up taking longer and adding another lecture, people seem to be happy about that. You know, why not? I'm working for free. So if it's value, then people will consume it. But the plan is, yes, today a lecture, another one 2 weeks from now, and another one 2 weeks after that. All of them on Monday at 5:30 p.m.
Yes, so I suggest that today we're going to also keep some time for questions, because last time we didn't have time for questions. Maybe, I don't know, you decide.
I'll speak less. I will speak less.
Like 10 last minutes maybe of today will be for questions.
Okay.
Okay, so I think we can start. And again, thank you, Oded, for being with us. We're here, the Gershon Fintech Center is hosting this mini course of PayTech by Oded Salomy from the Bank of Israel. And we've already had 2 lectures, very interesting, many great feedbacks. Now we're going to have the second part of the previous lecture. Oded is going to tell you about all those topics he went through. And yes, we're going to have 2 more lectures later on, bi-weekly from today. So, Oded, the stage is yours, please. Let's see that you have a full screen, right? Of the,
I'm trying. I can't seem to go to full screen because the Zoom dashboard is covering my full screen button. So I don't know how to. Okay, I'm going to try something. Stop share. 1 second. Okay, I'm not really sure. How do you do this? I did it last time.
Shift F5, somebody said it, but it's a PowerPoint, right?
It's a Zoom issue.
Yeah.
Do you see the screen right now?
No.
Okay. One sec. Try again.
Okay.
Shift F5.
Yeah, you do have
not working.
At the bottom of the right screen.
Yeah, but the Zoom thing is covering
it. So go to View, maybe, or F5 or something.
Oh, maybe View. Sorry, everybody. View what though?
Maybe if you try F5, usually it should work.
Try fit to window.
Oh, great.
I think it worked.
F5 worked.
Fit to window just changes the size with the same bars. Okay, so we're ready.
Yes, thanks.
Okay, everybody. Thanks for bearing with us. Welcome to what is now lecture 3. So lecture 2 ended up in the middle. So I'm calling it the second half of lecture 2, lecture 3 of this mini course called the PayTech Frontier. We had a little change of schedule because made a decision to attend Money 2020 Europe last week. And I thought, since I made the trip, and I know some of you did too, but many of you did not, that it may make sense to say a few things about what went on at Money 2020 Europe. Many of you may know that Money 2020 started 11 or 12 years ago as a fintech conference and evolved into the largest commercial fintech conference worldwide. It started in the US, but it is now happens twice a year. In June, it takes place in Amsterdam, and in October, it takes place in Vegas. It is quite a popular event. There were 6,500 attendees from 90 countries. There were 7 stages, so it was impossible to consume all the content because you couldn't split yourself in 7. There must have been, I don't know, tens of thousands of meetings going on at the same time as the lectures. Each, even just from a physical experience, it was interesting because each stage was different. One was kind of like a bar atmosphere. One was a closed room where they forced you to lock your phone in a case that they gave you. So you had to listen. You couldn't do anything else. And that was supposed to put the speakers at ease to say things they wouldn't otherwise say. No media in that session. There was a central stage, which was kind of like, the bigger, higher profile ones. Lots going on. There were banks, big techs, fintechs, and regulators. I counted about 100 out of 6,500 who were under the category of regulators and government officials, something like that. We put together a small little dinner for central banks that were attending. There were several. One thing that I thought was interesting was that even though it's not a regulators conference, there were a few central banks that came, and that those who came from smaller markets like Israel, and the persona of the people who came and the kind of approach to the conference, and I think to fintech generally, was we want to develop our market. We want to understand what can we do better as regulators to enable this innovation in our local markets, because we understand that we're not necessarily the first port of call for a new fintech. And so it was interesting that we had a lot to discuss. The conversations were very much, each one had its own flavor, but you could tell that a payments regulator in a small market has an added layer of ambition to try to attract activities beyond ensuring the stability of the system and some of the new making sure some of the new offerings do not have negative impact on existing financial activity. So some of the topics that were covered, I'm just going to go through a few real quick, and I wasn't able to attend all of them. Embedded finance was a huge topic. So embedded finance is the idea that as you're doing something that has nothing to do with financial activity, you get an offer which is financial and makes a lot of sense to you at that moment. So for example, if I go on a hospitality marketplace like booking.com or Airbnb, and I make a purchase, and using their algorithms, someone in the background or some technology in the background understands that I could use a loan to pay for this type of vacation. They offer me a buy now, pay later proposition that enables me to finance my vacation. And that happens just at the time that I'm making the purchase. That's an example of embedded finance. There are lots of examples of this. And it is an area that is developing. There was on the main stage, a session, which was a chat between Google Cloud and Deutsche Bank. And something that I found striking was that Deutsche Bank said that they now view themselves as a technology provider that enables their clients to embed financial offerings in the experiences of their clients' customers, and that they need to get really good at doing this type of technology if they want to be able to distribute their financial services. And the guy from Deutsche Bank was saying that in the past, as bankers, they spoke mainly with the chief financial officers, the CFOs of their corporate clients. Whereas now they do not limit themselves to the CFOs, but they find themselves speaking with operational executives from across the business, as well as marketing people at their corporate clients, because they want to embed financial service offerings in their corporate clients' customers' experiences, no matter what it is that they're providing or selling to their customers. Another huge topic was cross-border payments. I was heartened to see that some of the larger cross-border payment players that have a footprint in dozens and even hundreds of countries approached us as the Israel Central Bank, asking, how can they better service people based in Israel who need to receive funds, and people based outside Israel who need to receive funds from Israel. Lots around cross-border payments. Another big topic was crypto. So if we look at the exhibit hall, there were lots of companies exhibiting. There always are. And, many of them come there to find partnerships and make sales. But there always seems to be a couple dominant themes. I've been doing this for many years, going to the Money 2020 conference in either the US or Europe. And there's always seems to be a couple things that are dominant. So this year, I think in the exhibit hall, there were two dominant themes. One was cryptocurrencies as a means of payment, which is quite at odds with the way we think about cryptocurrencies as central bankers. We view cryptocurrency as a financial asset because it is quite volatile. It's a speculative investment, certainly in light of the downturns in recent weeks. And yet in the exhibit hall, you had many dozens of companies offering ways to pay with crypto. So don't know if that actually will become mainstream or not, but it is an interesting space to watch. In the context of crypto, I'll say there was a session that I was not able to attend, but I watched part of the video with an executive from Binance, which is a cryptocurrency exchange, which you probably know or maybe have used. But she made a statement which I thought was very interesting. It's actually on YouTube, which was that what she's really excited about is making the transfer of value free in a similar way to what happened on the internet where the internet made the transfer of information free. So conceptually, when she thinks about the upgrade from Web 2.0 to Web 3.0, she says when we go to blockchain, Web 2.0 or maybe 1.0 and 2.0 made the transfer of information free. 3.0 will add a layer of adding the transfer of value being free. Interesting concept. So on the exhibit hall, the other big thing that we saw was digital ID. There is quite a theme going around, certainly over the last year, but more than that, pay by identity. So we pay by card. What does the card do? It identifies me and connects to my account. We could pay by bank account. We'll talk about that later today. We can pay by check or whatever. But the idea now is that really all these things are just trying to identify us. And if you pay by identity, you don't need all these other forms of identification. It's a long-term, very strategic conversation for the industry, but it's one that I think is worth thinking about and understanding because there are lots and lots of propositions in this space, and they take different formats depending on the use case that the various fintech is trying to address. And then there were lots of themes, but one interesting theme that is directly relevant to our topic today was about the point of sale. So when you go to a store and pay by card at a point of sale, the terminal, which we talked about in the last lecture, this is what acquirers use. They connect to the point of sale. Some people call it the POS. In Hebrew, it's called a masuf, that black box. It is limiting because it is hardware and its security is tightly regulated by the Visa MasterCard rules and things like PCI DSS, which is a protocol that ensures security at the point of sale. And one point of discussion was, how can the point of sale become more flexible, agile, and interoperable with more than one payment method? So how can you use things other than cards to pay at the point of sale? And one theme that was recurring is something called a soft point of sale, soft POS. And you saw the video that I showed you that Apple posted on Twitter just a few days before our last lecture, where they enabled a person to become a business and accept payment on their iPhone as if that iPhone is a point of sale. So that's like a soft POS because it's programmable using software. And there are multiple iterations of how that can work. It's already live in many places. And that soft point of sale can accept much more than just card payments, some of which we're talking about today. So that's just a quick brief from Money 2020. Since we postponed the lecture by a week, I thought I'd share with you why we did that. Back to the commercial break I showed you last time. I'll be teaching at Hebrew University next year. Hopefully some of you will sign up for that. We will have the Bank of Israel conference on payments next week. This isn't really a commercial for those who have not bought tickets because we are now sold out. However, it is a commercial for those who did buy tickets. Please attend because every day I'm getting requests for more tickets and we are sold out. So if you were one of the lucky ones, please make sure you attend. We have lots of really interesting stuff there, including a fireside chat with one of the veteran, really top global executives in fintech at a marketplace, one of the platforms that probably all of you have used. And that fireside chat was actually something we pre-recorded, him and me, at Money 2020, which we will show at the conference. And of course, there's lots of content, including these lectures on the Bank of Israel YouTube channel. And we've done some webinars and other reports that we've published. So to go through what we're doing, lecture 1 was about the business case for payments. Lecture 2, which has now also become lecture 3, is about payment cards. So last time we talked about credit cards, debit cards, prepaid cards in the acquiring context. I have a little bit more about that, and then we'll go to the issuing context, and then we'll go to account payments, which we'll finish off today. That includes faster payments, instant payments, also known as instant payments, as well as ACH transfers and checks. As Ophira mentioned, lecture 4, 2 weeks from now, will be about digital currencies. And lecture 5, I'll try to be brief and cover 3 topics: cross-border payments, business-to-business payments, and a few words about payment regulation. So under payment cards, we talked about global brands and the way the market structure works. We talked about merchant acquiring. I'll continue and finish that off now, and then I'll move on to card issuing and account-to-account or A2A payments. So the last part of merchant acquiring, I'm going to just remind you quickly, a merchant is a business that accepts payments by card, and that business has an acquirer, which is a processor that processes the payments for that merchant. Without going into all the details, you'll remember what we discussed last time. And we also talked about the fact that acquirers who succeed are those who add additional services for the merchants and not just card processing. And we agreed that, or I explained that, some of those services can be financial services, including a service called BNPL, Buy Now, Pay Later, which has taken off across the world. It was also one of the topics last week at the conference. Even though we're seeing lots of companies in this space and lots of offerings, and we saw extremely high valuations, which have dropped with the rest of the market and valuations across fintech and elsewhere, it is still a burgeoning space and will continue to grow. So what is BNPL, Buy Now, Pay Later? You go into a website to make a purchase, or you come to a physical point of sale at a physical business to make a purchase, and instead of paying the full amount, the website or app or point of sale offers you to pay in 4 installments. The most common iteration of this is pay in 4. Now, we have this in Israel. It's called tשלומים, where the merchant often, or the cashier often asks the customer, how many installments would you like? And they're interest-free up to a certain number. The maximum number of installments in Israel is generally 36, 3 years, but usually it's a lot less than that, and they're paid off monthly. Buy Now, Pay Later, however, across the world, and again, it's almost like it feels like they copied our model. And in fact, one of the companies that's doing well in this space, or was doing well in this space, it was founded by Israeli entrepreneurs who understood this as a popular model in Israel, and why don't we have it in other countries? But anyway, the global version of it is, in most countries, it's paying it off every 2 weeks. So over 8 weeks, they pay off the entire amount without any interest. So what's the business model? How do you make money on this? Well, a lot of people want more than 4 payments over 8 weeks. And then the provider starts charging interest. So here we have an example from PayPal, one of the early companies that offered Buy Now, Pay Later. Get what you love now and pay for it later with Pay in 4. Our Buy Now, Pay Later option lets you split your purchase into 4 interest-free payments with no late fees. And of course, there is an explanation that there actually are late fees if you're ever late. It's interest-free, as I explained. It's available at millions of stores. You get a decision in seconds. So there is an underwriting process happening in the background, and this one is backed by PayPal. Just some explanations from the PayPal website on how it works. $80 purchase, pay $20 every 2 weeks. The first one is paid on the day of purchase, which is also, I think, different from the way it works in Israel, because the first one is usually paid at the next monthly billing cycle in Israel. And then you can go into your PayPal app and manage the payments see what they look like. Here you see some brands of stores where you can use buy now, pay later. They're saying there's 4 million stores. So usually, or let's say in the past, when a cardholder wanted credit, so they don't have enough money to make a purchase and they're going to borrow the money to make the purchase, it was offered by the issuer. In fact, this was one of the main ways that issuers of cards made revenue. And because the credit in most countries around the world, the credit on a credit card is unsecured. The issuer is not necessarily your bank. They don't have a right of set off against your current account. They don't have automatic debit from your current account. So they just have to hope and pray that you'll pay off your loan every month. Because of that, and also because the market terms dictate it, the interest rates by issuers were extremely high. They still are. Look in the US, in the UK. I'm not talking about 5 or 6 or 7%. It goes up as high as 18%. I've seen as high as 28% APR, annual percentage rate. And people do this. Why? Because it's easy, or because maybe they can't finance it any other way. But what happened with buy now, pay later is that it's no longer being issued by the issuer of the card. Rather, the credit is being offered by a third party working in conjunction with the acquirer. So when the acquirer goes to the store and says, I'll set you up to accept payments, they also say, I can also set you up to enable your customers to pay off the transactions with installments using buy now, pay later. So if you think about the market, this is some revenue moving from the issuers to the acquirers or to the acquirers' partners, and then the acquirers and their partners are probably doing a revenue share. So this is great for consumers because they can buy more stuff in the moment for a low or lower cost, at least perceptually, because they pay very little upfront. Disadvantage, they end up spending more than they should, maybe some of them. A recent survey showed that 28% of consumers used buy now, pay later last year. So that's pretty high penetration at this point. I think that was in the US. The research shows, and I have to say, in preparing this presentation, I was surprised. I didn't realize it's this extreme, that millennials really don't like credit cards. They were traumatized by the financial crisis of 2008 and 2009, and they're scared of losing control of their finances by having too much credit. So this whole concept of a credit card is not as intuitive to millennials as it is, for example, to people in my generation. And yet they feel comfortable using buy now, pay later. They like it better. Why? Because they understand it. It's for a specific transaction. I want to make an $80 purchase. I'll pay off $20 a month for the next $20 every 2 weeks for the next 8 weeks. That's easier for me to understand. If all my expenses go on a credit card, I might lose control, and then I'm going to start paying interest, and I'm going to get in trouble. So the target audience for these people are this offering are people who roll their balances. So sometimes that can become complicated and get them into trouble. And yet they like the buy now, pay later proposition. And it's also good for transactors, meaning people who use cards a lot. And what that does, the reason the industry likes this is that the high transactors generate a lot of interest fee income. I hope you remember from the last lecture, sorry, not interest fee income, interchange fee income. Hope you remember from last lecture, interchange is the amount that's paid by the acquirer to the issuer. It's a percentage of the transaction. And so transactors that bring a lot of volumes enable the industry, the issuers to earn more. Very interesting that the company valuation, that Australia, first of all, for some reason, the Securities Exchange in Australia has been a home to buy now, pay later companies. The Israeli company that I mentioned earlier was listed in Australia for this reason. They got a good valuation, better valuation there than they would have elsewhere, because the Aussies, for some reason, appreciate or understand this space more. There were many questions around the high valuations, and crash came in recent weeks, and the buy now, pay later category company valuation decreased by 92%, which is certainly raising questions about the feasibility of this model going forward. And yet there is a true market need for it. Where the company valuation drops, it does make it more difficult for these companies to get access to funds. Their cost of funds increase. And one of the reasons that their valuations has dropped recently is that the industry has become aware and the models have proven that the buy now, pay later algorithms are not as good at managing risk as people thought, which caused a lot of credit losses. And so that also challenges the model. I think that's a temporary thing. I think the underwriting models will improve and the algorithms will get smarter. So it provides credit on impulse, quick digital underwriting. It's a low average ticket. In the past, it was very difficult for most financial entities in the world. It still is to underwrite a transaction at a cost of $80. It's just not even worth bothering. Why put time into it? But if it's all done technologically, that is possible. And one trend that we're seeing with buy now, pay later is that the consumer protection agencies or relevant regulators are beginning to ask questions about whether consumers are sufficiently protected. So some headlines for you to demonstrate how active this space is. I made this deck 3 weeks ago, and you'll see on the upper left, it says Apple and Goldman Sachs to launch Apple Pay Later, a buy now, pay later service. And just a few days ago, Apple actually launched its buy now, pay later service. So it is a real thing. Square bought Afterpay, which was, I think, the leading buy now, pay later company for $29 billion. Probably would be worth a lot less if they were to make the purchase today. Amazon partners with a company called Affirm, offering BNPL as well, and lots of startups around the world making this offering. So that's the end of the section on merchant acquiring. Let's move on to card issuing. So we talked about what issuing means. Just want to kind of put up here on the screen examples of some banks that issue cards. This doesn't mean they're good or bad or that I like them or dislike them. I made sure to put an Israeli bank on there that doesn't say anything. I could have put any of the other Israeli banks. People who issue banks, the entities that issue banks can be large banks, large global banks like Citi, Santander, HSBC. They can be neobanks, or what are known as challenger banks, which were established as fintechs just in recent years and have grown. Revolut is either the largest or one of the largest digital banks. They can be banks that have been around for years but do not have branches. And those are actually called monoliner banks because all they do is issue credit cards. There are entities like this. Capital One is an example. Wells Fargo is a traditional brick and mortar but huge bank in the U.S., based in the U.S. Bank Leumi is an Israeli bank, and NatWest is in the U.K. Just to give you an idea, there are 8 on the screen, but I think there are something like 12,000 issuers around the world. Okay, it's a huge space. For every acquirer, there are, I don't know what the current count is, but let's say between 5 and 10 issuers. A lot more issuers than there are acquirers. The number of issuers continues to grow because they're not only banks. They can also be fintechs and big techs and even retailers. How do you make money as a card issuer? You make money on interest income. So if the cardholder doesn't pay off the full amount on a credit card and they take the rest as credit and pay it off in future months, future billing cycles, the issuer charges interest. As I said earlier, very high interest because it's generally unsecured debt and interest on credit cards is quite high. The issuer charges annual fees or monthly fees to the cardholder. For cross-border transactions, they charge foreign currency fees, which are quite a nice source of income for them. In some countries, they give a cash advance to the cardholder, either through an ATM withdrawal or even sometimes through a wire transfer into the cardholder's bank account based on the cardholder's line of credit, and they charge fees for that. Especially in the US, late payment fees are a big source of income because it's not automatic. The payment doesn't get deducted automatically from the bank account, from the cardholder's bank account. Rather, the cardholder, in many cases, still writes a check or needs to proactively go onto a website and make the payment. And so they often miss the date and they end up paying a fee for that. Sometimes they sell other products like insurance, make money from that. Sometimes there are cardholders that roll their balance from one card to another because, let's say, they can get free interest for the first 3 months after they do the balance transfer, but they don't seem to notice or care or tell themselves, the cardholder tells himself some kind of story that, it's just a fee, it's not really interest, but boom, suddenly they're paying $25 or $50 for a $500 balance transfer fee. So, that's a nice source of income for the card issuers as well. And as we explained earlier, the acquirers pay an interchange fee to the issuers on every transaction. That fee can be, in Israel, it's published at 0.55% going down to 0.5% for credit cards and 0.3% for debit going down to 0.25% in a few months. And it can go as low as 0.2% and can go as high as 1% or even a little bit higher. So that's an automatic source of income. Anytime anyone spends money on the card, the acquirer pays it to the issuer. And you'll remember, where does the acquirer get the money? They're charging the merchant. Okay. And where does the merchant get the money? They're probably pricing that into the cost of goods and services sold to the customer, to the cardholder. What are they spending money on? What are the issuer's expenses? Well, cost of capital for the credit. Non-performing loans. There are significant volumes of non-performing loans. You just understood how this industry works. So it is much higher risk than normal loans, than other types of loans lended by banks to individuals and businesses. Fraud is an issue. Operations are expensive. 24/7 customer service. Collections for non-performing loans. Marketing, let me tell you something. If you've lived in the US, and I know many of you have, you're probably still getting snail mail several times a month by issuers trying to sell you their cards. And there's lots of other marketing and cardholder acquisition methods. Rewards. So one of the best ways to influence cardholder behavior is to give miles, frequent flyer miles. So you sell the concept to the consumer, spend money and get a free flight for your next vacation. And suddenly that consumer is moving all her spend to a particular card in order to earn enough points, enough frequent flyer miles to get a free flight on their next vacation. So that proposition actually costs the issuer money. The issuer has to pay the airline for those frequent flyer miles. Sometimes issuers give cash back or other types of loyalty programs, which cost the issuers money. And the issuers also pay the global brands for the right to use their brand, as well as their rules and technology platforms. So if we're still talking about cards, let's kind of just think about a few ways to categorize them. Prepaid debit, deferred debit, or credit. So pay before is prepaid cards. Pay now, money comes immediately out of your account. Debit cards. Pay later is like what we have in Israel, deferred debit. So it's not debited immediately, but it is automatically debited once a month. And pay even later, I call it, is the true credit, where you pay a certain minimum amount, and that the rest of the balance revolves and entails interest payments. So it's very interesting that different markets have different personalities. So when I was at Visa, we would think about a market as, we would ask, is this a credit market? Is this a debit market? Is this a credit and debit market? So Israel is considered a credit market because deferred debit means that on average, the consumer gets 17 days of free credit before they actually pay off the transaction. The UK is largely a credit market. Well, I'll get back to the UK. Spain is a credit market. Turkey is a huge credit market. If you think about debit, that means it's a country where people don't feel comfortable taking out a loan to make purchases. And so they prefer a debit card where the money gets automatically deducted from their account. So Germany is a debit market. The Nordics tend to be debit markets. These tend to be cultures that want to make sure they're very much aware and in control of their finances at any given time. They don't want to take on debt that they don't have to. And so those are debit markets. And then there are markets that have become credit and debit. And so the UK and the US are classic examples where most consumers have at least two cards, where they have one debit card and one credit card. So for small everyday purchases like a coffee or a newspaper or breakfast, they'll use their debit card because it doesn't make sense to take out credit for these types of small daily transactions. But when there's a high ticket item like a vacation or a piece of furniture, then they'll use their credit card and kind of spend a little more time thinking about how they should pay off large ticket items. And one piece of advice for entrepreneurs is before you launch in the market, if you're offering a debit product or a prepaid product or a deferred debit product, whatever, try to make sure you understand what kind of market it is. By the way, I didn't say much about prepaid. There are many use cases for prepaid. You can use it for all kinds of things. It could be gift cards. It could be insurance claims. Insurance companies that want to pay off their claims, they can send a prepaid card to the insured. But what's very interesting is that Italy is a huge prepaid market. I think it's the largest prepaid market in the world. They do everything on prepaid. They prefer to put the money on a card before they spend it, and then they use up the amount stored on the card, and then they reload it again. So there are also markets that are prepaid markets, interestingly. So when we think about types of cards, there's another way to think about the taxonomy. Classic, gold, premium, and high net worth cards kind of talk about the socioeconomic, more economic background of the cardholder. It seems to be a status symbol to have a black card, like the Chase Sapphire card, for example, or the HSBC Premium Black Card, because it means you come from a higher economic background. And the, let's say the starter's card, student just graduating or just starting college might be more likely to get a classic card, which means probably a smaller credit line and fewer benefits because the issuer doesn't feel as comfortable underwriting a large credit line. This is no longer an accurate description of the cardholder because there has been a shift. There has been an inflation of types of cards, meaning a lot more people get premium cards than they used to because everybody wants to be a premium customer. That doesn't necessarily they really are a premium customer. It just means that the marketing team made a decision to give more premium cards because they want more customers. And then on the upper part of the slide, you see another type of category, which is consumer cards versus commercial cards. So the vast majority of cards are consumer cards. They're issued to individuals, but there are also many commercial cards. It's a small category. It's a small group. I think it's well below 10%. Globally, I think it's far below 5%. But what are commercial cards? These are cards that are issued to businesses. So imagine a business owner that wants to buy inventory. They could buy that inventory with a payment card, more likely to be a credit card because they'd like to have the credit line, but it could also be a debit card. And in many cases, the business owner has a separate segregated bank account for business expenses. So a debit card would enable that business owner to buy inventory. It's like a check, immediately debiting the bank account, and yet it comes from the correct account. One interesting success story at Visa from many years ago was something they called the check card. They wanted to promote debit, and so they said they wanted to the business owners and also consumers to understand what is this product? Because at the time they had only credit cards or mainly credit cards. So they made up a new name. They called it a check card. And basically that was a debit card for business, enabling businesses to pay off their expenses immediately, but they could do it by card. So each of the four categories on the left are kind of a matrix with the top two categories. So you could have classic consumer cards or premium consumer cards. You could have gold commercial cards, and so forth. I would say that it's even more complicated because each of these can also be prepaid, debit, deferred debit, or credit. A few things about the technology on the card. There is a 16-digit number on every card, which you all know because you use it. The first 6 digits, it used to be the first 6, and now it's the first 8 digits, are known as the BIN number, B-I-N, Bank Identification Number. And it is unique. It identifies the issuer of the card and also identifies what kind of card is it based on the taxonomy I showed you earlier. It was just 6 digits, but Visa and MasterCard ran out of BINs. So they needed new BIN numbers, and they added 2 more digits. These BIN numbers are managed very closely by the global brands, and there are various versions of it in other payment systems as well. I can tell you in Israel, we have a bank code, which the Bank of Israel manages, and it's only 2 digits. So we have 99 bank codes. The BIN numbers are really kind of like the genetic code of the card industry. And when an issuer receives a license from Visa or MasterCard to issue cards, it means they become a member of the organization. They also get a BIN number, and that's kind of like a source of pride. They don't actually own the BIN number. It's proprietary and it's owned by the global brands, but for all intents and purposes, they have an exclusive right to use the BIN number. And sometimes an issuer gets more than one BIN number because, for example, they might want to issue credit cards and debit cards, and they might have a different BIN for each. And some issuers, by the way, will use, let's say, digits 8 or 9 and 10 to identify the card in another way. So they might say, okay, all the loyalty cards belonging to a particular retailer that's going to give benefits will be digits 9 and 10, whatever. In places 9 and 10, we'll have digits 5, 6, whatever it is. And so there is a whole art around how to manage BIN numbers. Form factors. What's a form factor? It's the way the card is used. Is presented to the cardholder. So we all know the plastic card. That's easy. Here you have a picture from an Israeli issuer called Cal. I mean, if you live in Israel, so you know them. They're often referred to as Visa Cal. And they have something on their website that enables you to upload any picture you want and have a card printed. Normally, that's not the case. Normally, there is a standard card design. Every card design before it goes to market has to be approved by the relevant team at Visa or MasterCard or one of the other global brands. But there are other form factors. Look on the left. You see a Apple Cash card by Visa, which is virtual. So it has a picture of a plastic card, but it's not physical at all. It's a virtual card issued into your phone. Now, they might send a plastic card, so you'll have one in your pocket, but you don't need it. You can just work with the virtual card and put it in your wallet. And just as we can pay not contactless payments using a smartphone, you can also do that now with somebody's drawing on my screen. I have no idea why that's happening. So if you could stop, I don't know. I'm not moving anything. There is also a watch capability. So smartwatches have chips in them like the phones that enable you to use your watch to make a payment. Some of you may be familiar with Fitbit. Fitbit launched a payment capability, and you can use your watch on Fitbit to make a payment. Keychains and implants are another form. So if you see this X-ray here, this is actually real. There are people in the Nordics that pay. They take with their hand, but it's not with their hand. It's with the chip that's installed in their hand. This is a real thing. So if you have the chip installed in the phone or in the plastic card or in the watch, you can also install it in your hand, okay? Implanted. And there aren't many users like this, but some think this will grow, and then we won't carry anything with us. The chip in our hand will enable us to put our hand near the credit card terminal, and it will read our card number in an encrypted manner. So I don't know why there are these two blue lines on my screen. Whoever drew them, please try to remove them. Two blue lines and a dot here. I don't know. I don't know where that came from. Someone did something. You know what? Let me unshare. I do not know how this happens.
Yeah, it might happen if somebody on his smartphone can do that. Yeah, maybe if you reach.
But on my, I don't know. I don't know how that happened. I'm gonna
touch their smartphone. They can.
I'm gonna reshare. Okay, it's gone. Please try not to do that again.
Thanks.
Who remembers how I went full screen?
F5. F5, try.
Not working now.
F5.
Oh, God.
Great. Fourth.
Yes, but I lost my place. Okay. So, super apps are applications that enable you to put multiple features in the same app. There's another name for it that I saw called super wallets, which enable us not just to put a virtual card in the app, but also enables us to do other things like make a reservation at a restaurant or at a movie theater, or see my flight tickets, or even chat with a friend. And the place we see super apps growing like crazy is in the Far East with WeChat Pay and Alipay, but we're seeing them coming out of mobility platforms and growing, spreading into markets across the world. The word super app has multiple meanings depending on where you look. So if you're in the West, mainly UK and US, but we're seeing this in other markets as well, a super app is usually an app that starts with payments and adds additional financial services. So maybe on the same app, you can buy insurance, and maybe you could convert currencies, and maybe you can save money and invest it. That's what people mean when they say super apps in the West. But what super apps really are, in my mind, is where they started, which is in China and have spread to all over Southeast Asia, which is not just financial services, but non-financial services as well. You may remember early on in my first lecture, I explained that the reason businesses and entrepreneurs go into payments is because they want the engagement with the consumer and the data about the consumer, and they want to use it as a platform to sell other things, including other financial services and other non-financial services, like a taxi ride or a massage. And that is what the true full super app is. And I think we're going to go in that direction worldwide eventually, so that we'll have one screen where our eyes are, and we can get all our needs met on that one screen, rather going into in and out of many apps. Because, you know, one of the things I heard at Money 2020 last week was payments are everywhere and they're in everything. So this whole thing called embedded finance, it's kind of like a misnomer, because no matter what you do almost in the world, you need to be able to make a payment, and let's embed that in the experience. So I think that's the direction where the true super apps will ultimately go. So a digital wallet is kind of one step before a super app, which means you can only use it to make payments. And here are examples from the Far East and from Israel. So you remember we talked about the platforms that sometimes are standing in between the issuer and the cardholder. And sometimes the issuer provides these platforms themselves. And their goal is to provide additional offerings to the cardholder. Since I've got the cardholder already looking at my screen, or maybe at my card, that means that I can try to sell them something else or provide them another service. It triggered a thought that I wanted to say earlier, so I'll just say it now. When I entered the industry many years ago, someone made a statement that I've remembered ever since. It sounded very weird to me, and over time I understood how real and how true it is. And that statement was, you manage your relationship with your bank through your card. I was like, what? But you know what? Think about it. How many times a day do you touch your bank? How many times a day do you see your bank or talk to your bank? And even when it's virtual, how many times a day do you actually access your bank app? Some people do. I know a woman who checks her balance every day. That's quite unusual, okay? Most people don't have that much contact with their bank. But your credit card, you take that out, look at it, and use it. If it's not every day, then it's almost every day, depending on where you live. And so when it becomes digital, there's lots of conversations around mind share and brand awareness, to the point that some issuers are willing, certainly with debit cards, to have the portfolio not be profitable because it's very important for them to maintain the emotional almost relationship with the cardholder and make sure that cardholder continues to remember who the issuer is, because they might be able to provide other services to the cardholder. So some of the other services that issuers offer include financing alternatives, other financial services on the same app, which I mentioned, as well as non-financial services, security, authentication, identification, which, by the way, can be used for things other than payments, even like a building access card. If you're an employee, how do you get into your building? You could combine the two. And then loyalty and rewards and air miles we discussed earlier. These are things that issuers can couple with the simple payment. Trying to do this quick because we wanted to leave time for questions. So it's almost 6:30. I have 20 minutes for account-to-account payments. We should be good. So an account-to-account payment means move money from one bank account to another bank account without any intermediaries. And I said bank account to make it simple, but it doesn't even have to be a bank account. It could be any account where you manage money. Let me be concrete about it. PayPal enables you, I don't know how many of you used PayPal when it first launched, even before it came to Israel. In the early days, you would need to load money onto your PayPal account. I don't know if you had to. I remember I felt I had to. Maybe I missed it. I think it was the only way to work with it at that time. This is over 20 years ago. So you loaded money onto your PayPal account, and then when you made a purchase, it was debited. So that's almost like managing a current account at a bank. Okay. So there are fintechs mainly and multiple scenarios where people do manage accounts and manage balances in wallets that are not banks. Okay. And in Europe, these are called e-money institutions. So if you want to move money from an account, whether it's at a bank or at a non-bank, to another account, that's called A2A, account to account. And there are many ways to do this. You could do a wire transfer, also known as an ACH, through the ACH clearinghouse. Typically takes 3 days. You could do an RTGS transfer if you have the IBAN number of the beneficiary. That's typically used for large value payments because the process seems to be tedious and you need to really understand banking in order to make that payment. So if you're making a down payment on a house or on a car, it might make sense, but it's not done that often. You could write a check. What does a check do? It moves money from one bank account to another. And we have a digital check project in Israel where we want to make the paper check digital. Why not? And you could do something called an instant payment. In some countries, it's called a faster payment. In Israel, we call it faster payments, which means it is just like an ACH wire transfer from one account to another, but it doesn't take 3 days. It takes a few seconds, and it's final. So if I initiate an instant payment to my friend, I will see the debit in my account. They will see the credit in their account within a few seconds, and it's done. There's no going back. You'll remember when we talked about cards, we said the anatomy of a transaction includes three elements, which were authorization, clearing, and settlement. Remember, we talked about how in the olden days, you used to go to the store and they used to check if you were on the blacklist. And if you weren't, then you got your card authorized. Sometimes they called the help desk to get the authorization and they wrote it down, the authorization number. And then at the end of the day, the storekeeper would take all the pieces of paper with the different card numbers whose imprints they received to the bank. And that was like clearing. That's like sending all the data in a batch file to the bank. And then that night, the money would actually move, and that was called settlement. So what's the anatomy of a transaction when it comes to an A2A? So authorization and clearing happens instantaneously. I apologize. Need a 10-second break. Okay, here we are. Am I muted or unmuted?
No, it's okay.
Okay, so authorization and clearing happen at once. It's not a two-step process. And then there is it usually takes 3 days to settle the credit exposure. However, the banks or the entities in the instant payments framework are the ones taking the credit risk on each other. Why is it a credit risk? Because the receiving bank guarantees payments to the cardholder or the account holder, and the paying bank, the transferring bank, could actually have an event of default or could go bankrupt before the 3 days end. And it does take 3 days for batches to clear. So what faster payments do is they go to everybody participating in the system and say, sorry, you're going to take the credit risk, but it's going to be mutual versus all of the other members in this system. And so even though the cardholders see the money move immediately, the banks actually have 3 days until they see it in their accounts. And it works both ways. So usually if Bank A, account holder from Bank A makes an instant payment to an account holder in Bank B, that probably happens in reverse. There is also an account holder at Bank B making a payment to account A. It's never equal. There's always one that's going to have more exposure than the other. But that's kind of like the beauty of instant payments, is that all the players take this risk and it works 24/7. So you don't have to wait until the batch moves and you don't need to wait 3 days. And it is now, we're beginning to see around the world, beginning to penetrate and create volumes, including in retail payments. And it's even beginning to compete with some of the other retail payment methods. So here's a report, a map from a report that we saw. It's a couple years old already, showing where instant payments have launched. It is a global trend. If we talk about some of the players, so the best known one is a company called VocalLink in the UK. They were purchased by MasterCard. I think it was for £900 billion a few years ago. Certainly raised my eyebrows. You know, why are they doing this? Why would they want to enable account-to-account transfers when they've got this huge cards business? Really, it kind of competes with debit cards, right? Because the money moves immediately out of your account. But I think what both MasterCard and Visa now realized was that this space is going to grow. And it might end up cannibalizing cards. It'll probably grow more in spaces where cards are not relevant. areas of the economy that are not cardable. And yet, even though there is some cannibalization, they need to be a part of the game. They want to continue to be relevant. So why not make it good and better? And so MasterCard bought VocalLink in the UK, but VocalLink is active in multiple countries across the world, including the Far East. ACI worldwide, Finastra, which has a big presence in Israel, FIS, all these entities provide technology for instant payments. So why instant payments? Why does it need to be so fast? So there are use cases where it meets an unmet need. Things like an online brokerage. Think about Robinhood in the United States, which enables people to download an app and start buying and selling securities. So why is an instant payment important? Because the provider, the online brokerage, has gone through the trouble of marketing the app, getting the user to download the app, identify themselves and everything. And now that user wants to start trading securities. But that user has to wait 3 days. Now, in terms of user experience, that's catastrophic. They may not actually end up trading any securities because the way the modern world works, we have a hard time staying focused for 3 days on such a thing. And so if the same online brokerage could receive the payment instantaneously, it would be much more likely that that user within a few seconds will actually move to the next step, which is begin trading in securities. Another example is government payments. Governments want to collect funds as quickly as possible from their taxpayers. Releasing goods from customs. So if I order something on AliExpress and it arrives and it gets stuck in customs, the customs agent will contact me in one way or another and say, okay, you need to pay $20 worth of fees in customs. And I, the customs agent, will not release your goods until you make the payment. The speed of which payment is made is really important because until I make payment, the goods are stuck at the port in a customs agent's warehouse. And you could save all of that by making an immediate payment. Now, they don't necessarily want to accept card payments. They generally do. But, if we look at online brokerage, for example, that really impacts the return on investment. Because why do you buy securities? You want to make ROI, or even government payments. If they end up paying card fees, that directly impacts the amount of money they collect from the taxpayer. So instant payments tend to be much, much cheaper. The fees are not structured as, unlike cards, the fees are not structured as a percentage. So it's not X percent of the value of the transaction. Rather, it's a flat fee, tends to be very, very low, cents. And it doesn't matter. You could move $2,000 for 2 cents. And don't take the 2 cents as a necessary benchmark, but do accept it as a very low fee. And there are much fewer intermediaries in this type of payment system. The disadvantages of instant payments: not as many businesses accept them yet. The framework is not as well developed, and there are not as many rules to manage things like disputes and fraud. There's no chargeback protection. So if somebody steals your identity or your card number and makes a payment, the protections you have are much lower, and consumers don't really understand it. So there's still a lot of consumer education that's required. Some of the better known instant payment platforms: Europe is on the Target platform. There's an instant payment platform called Tips, which is huge. FedNow in the United States, still early days, but we expect it to progress. Sorry. I want to go back. In Europe, the Target and Tips platforms were by the European Central Bank. FedNow instant payments is really launching full scale in 2023. In Australia, NPP is owned by 13 organizations, including both banks and non-banks. And in Israel, the national ACH platform, Masav, launched instant payments, and 4 of the 5 large banks in Israel already make it available in their apps. Some of you may not be aware of it, but it is available in your app. chiyuv miyadi, if you look at it, or tashlum miyadi. So one of the things instant payments are used for are person-to-person payments, P2P. I know most of us live in Israel, and the apps used here for P2P, which are mainly Bit and Paybox, do not work this way, but that is quite a rarity and an outlier exception. Most places around the world, there are these platforms that are launched by multiple banks or by the central bank and enable the users to move money to each other. And each one of them has a different version and a different name. Many of these are known as alternative payment systems. When I was in Holland, I saw Ideal, that the CEO of Ideal is a former colleague. He used to be a country manager in Holland when I was the country manager in Israel for Visa. So it's interesting because he's actually regulated by a regulator who's kind of like the same position as me. So the payment systems regulator in Holland is actually overseeing the Ideal platform. And in the Nordics, you'll see here Mobile Pay in Denmark, Vips in Norway, Swish in Sweden. In the Nordics, this type of payment has really taken off with very high penetration. And Pix in Brazil was recently launched and has had great success displacing cash. So regulation is key because in many of these markets, the legacy players are not interested in promoting instant payments. They might cannibalize or might be expected or perceived to cannibalize fee income for the cards industry or for banks who make money on wire transfers. And so what we've seen globally is that it is the regulators who often cause the launch of an instant payments platform or scheme. And even if they're not the ones that trigger the launch, they're often the ones who take actions to increase volumes, to ensure things like standardization. In the UK, there was even a requirement to ensure a consistent customer experience across multiple banks. And it's a place where regulators need to ensure that this new type of payment method gets its chance because it is a new market entrant, often using legacy players' platforms to gain volumes. So we made it through quickly, and I'm really glad about that because it means we have time for questions. What I do request is for you all to turn on your cameras because while I do like looking in the mirror, I would prefer to see what you guys look like. So if you could raise your hands, or Fira, why don't we do this? Why don't you call on people and let them ask questions?
Yes, let's, whoever has a question, you can start and the others can, raise a hand, the digital hand, or else.
Well, we can either end here, or I could ask you a question. I prefer if we have a question coming from you. Shira, no questions?
Yeah. Maybe just refer, but you mentioned briefly, since I came from a credit card issuer and acquirer up until a couple of years ago.
Please share with us which one.
Max, I was part of the innovation team. As you know, maybe some of the other participants don't. So I know there are a lot of challenges, strategic challenges in the market today that are very much related with the competition between banks that used to own, at least in Israel, that used to own the payment service provider, not PSPs because it's a different term, but The
card companies.
The card companies, and now, but it's not only cards, it's payments in general. That's why it's so confusing. But there is some stress and challenges between the fact that payments has become a commodity, or means of payments have become a commodity, and on the other hand, it was a very profitable business at a time, and now there is a lot of, the power game has created some stress in the system. So maybe the fact that A2A is a mean for banks to actually take card companies or other payment companies out of the game, to take them out of the. So there is a complexity there that I love to hear your thoughts about.
Okay, so I think it's a good question. It's certainly one that we have our eyes on as regulators, and there are several regulators in the payment space in Israel. I think it's interesting to understand the market dynamics. So the Sturm reform required the two largest banks to sell their card subsidiaries in order to increase competition in the market, with the hope and expectation that these card companies would provide financial services and maybe even become banks themselves. I think what the reform did not truly, totally internalize was the concept that the card companies continued to be dependent on the banks because they also provide issuing processing. And as a result of that, they need to be very careful about what kind of strategic moves they make, because they want to retain their largest customers, which are the banks that used to own them. So that having been said, I'll say a few things. In the Israel market, there is quite a lot of innovation in the payment space, but it's very different from what we're seeing in other markets. And it's very interesting to understand what is the strategic position of each of the players in comparison with their product decisions, right? So are they making a product decision because they're stronger or weaker or whatever it is as a result of the separation of the card companies? Or is it because it's what really makes sense for the market? And how do we as regulators balance between the two? I can't say anything completely intelligent about this point without compromising some of my confidentiality obligations. But I will say that we as regulators of payment systems have taken significant steps to do two things. One, increase the independence of both platforms. So we had Masav for ACH and faster payments, and we had Shva for card payments and ATM payments. And they had the same management team, and they had the same everything. And so we have worked very closely with the competition authorities in overseeing and advising the separation of the two companies. And now that they have separate management teams, we believe that each of the means of payment will be more independent in the strategic decisions that they make, and we believe that's happening. And we've also taken steps, as regulators have across the world, to increase volumes on instant payments. The most significant of which is that we required the implementation of something called request to pay and request to respond on faster payments, which are mechanisms that make it easier for third parties to offer instant payments to cardholders. So I didn't give you a complete answer, but just some thoughts. Shmuel and Johnny Paul, I saw you on here. I'm going to ask you to ask me a question. I'm not going to let you escape. Shmuel.
Yeah, unmute yourself.
We can't hear you.
Yes, we can't hear you, Shmuel.
We see your lips moving. Microphone's not working. Okay, don't know why. Johnny, so I'm going to tell you, Johnny, why don't you tell us who you are? I'll tell you guys something. I saw him last week at Money 2020.
That's right. Yeah, good to see you. You I saw you running around. You were so busy, but then I saw you getting a cab to a party later. So I guess you weren't that busy.
That wasn't me. I didn't go to any parties. I attended some dinners though.
That's what it was. Yeah. Yeah, hi. It's good to meet everyone. My name is Johnny, as Oded just mentioned. I run Fintech Week Tel Aviv, which Oded was a star this year, weren't you? You had a star slot on day 3. So yeah, we run it every year, usually in March, but sometimes in February.
So, and you do it all over the world, right? You do DC, you do.
No, that's not. No, I do work. Do one in Dubai, Fintech Surge, which is coming up in October. That's part of Jitech's Technology Week, which unfortunately have managed to organise during the week of Sukkot.
Okay.
Which is master. But
any questions?
I think you covered it. I mean, I am very interested in the account-to-account offering and how that will come into play, and how that will with blockchain as well, especially how will that sit alongside the blockchain payment?
So, I mean, right now it's not on blockchain. I don't foresee that it will be on blockchain. Blockchain is actually a slow technology. It's not mature enough. Maybe one day it'll make sense to turn blockchain into a platform for retail payments. We're not there. But you live in the UK, right, Johnny?
I'm in the UK, that's right, yeah.
So do you ever make instant payments or receive instant payments?
Well, I guess. I mean, we bank, I guess we can say that we have the only profitable neobank in the UK, which is Starling. And I think they've fallen short, all the neobanks. You get a nice, sexy coloured card, but I don't think they're quite there yet. I think people haven't. I mean, there's mass adoption, but I think people still keep legacy banks as well. I still have my main account with NatWest, which is one of the big banks there.
Okay.
So it's an interesting see how that will develop.
Sounds good.
How's it going with what's going on with 1.0 as well? We get little snippets of information.
They're in production. They're in production with their pilot, and they will soon hopefully have a larger launch. So I see there was a question written by Shmuel. I can't see it. It flashed up and down. So maybe Ophira, you could read it.
Just a moment. Okay. From their point of view, will in the age of open banking, service bureaus like Masav Shva be needed? That's his question.
Oh, okay. So I didn't say anything about open banking or payment initiation. What is open banking? Open banking is a requirement of banks to open up their internal systems, their technology platforms, to external third parties. So let's say I'm an account holder and I have a mortgage, and a third party wants to find new customers. So they get me to consent in some digital fashion to let them look in my bank account and see, look in everything I do at a particular bank and see what are the terms I got, let's say, for my mortgage or for my credit card or for whatever. Because the bank was required to open its systems with open banking and APIs, that third party will be able to access my data with my consent in my bank account and see my information. So that's one category, and then maybe make me a competitive offer, not necessarily with their own money, maybe with somebody else's money. That's the first category of open banking, which is access to information and data. The second big category is called payment initiation, which means I'm the account holder. They get my consent to access my bank account and my consent to move money from my bank account to somebody else's bank account. How would they make that A2A payment? Could be through RTGS with an IBAN number. It could be through the ACH platform as a wire transfer, and it could be as an instant payment. However, all the open banking did was it allowed someone else, some external party, to access my bank account and bank information without me having to do anything other than give my consent. As soon as they try to move the money, they still need the system, the platform that enables the movement of money, such as Masav, which you asked about. So no, it does not make them irrelevant. In fact, it might make them more relevant because some of these third parties, the fintechs, might want more services from these platforms than the banks currently consume.
So Oded, I have a question.
Yes.
Regarding privacy issues, you mentioned, all those different usages for same payment cards, much more than payments. So how do you see it, the challenges of privacy issues for people using their identities, using other information? How would it not go to the wrong places, or being manipulated?
Okay, so first of all, that is an absolutely great and wonderful question. I gave a lecture to something called Central Banking. It's an organization that provides content and training to central bankers about the role of big techs. And one of the issues relating to big techs, such as Google, Amazon, and the like, is the concern that they'll use the data and manipulate it against the best interests of the user, right? So why do we care about data? Because we've seen elections in other countries that have been manipulated by big techs that actually influenced people's opinions by sending them news feeds that are tailored to cause them to form a particular political opinion and really impacted elections. So why wouldn't they do that for financial decisions? Might they cause me to take a loan for a larger amount than I can afford or at a higher interest rate than I could get elsewhere? It's called destructive innovation, a play on words that we used to call it disruptive innovation. So lots of regulatory thinking around this topic. There is a balance that needs to be stricken between innovation and privacy, because the way we can prevent this type of manipulation, and by the way, I didn't even talk about what you're worried about, which is invasion of my privacy. What if somebody steals my identity? I'm going to have to spend 12 hours or whatever the number is, 20 hours regaining my identity, getting all my new cards, all these things. I'm not even talking about that. I'm going to the next step, the destructive innovation that could result from manipulation of personal sensitive data. So I could prevent all of that by just saying no access to data, period. You can't use consumers' data. As a regulator, not a central bank, but there are regulators who look after privacy issues. In Israel, it's the Ministry of Justice. The privacy regulator could just say no use of data, period. But guess what that's going to do to innovation? It will kill it. Because data is the new oil or the new gold, or call it what you will. So instead, we need to find a balance. How can we allow innovation? And one more thing. We could say to Google, who launched Google Pay, we could say to Google, you can't use data. Will that, for financial purposes, will that prevent Google from engaging in destructive innovation in finances? Maybe, but it might do something else. It might cause Google to go to the existing legacy players, the banks, and say to them, hey, you want really cool information about Oded Salomy? Did you know that he's in dire straits and he needs a loan? You could probably extort a very high interest rate from him, all done by algorithms. And now what happens? We lost Google as a competitor to the legacy players, and we got the destructive innovation channeled into the market through the legacy players. So no competition and destructive innovation. Is that something we want? No. So we need to strike a balance, and it's very detail-oriented. There are no clear rules about this. It has very much to do about anonymizing data. So maybe allow them to use bundles of data or certain types of data. And there's another approach to it, which has more to do with user consent. the opt-in model. Let me ask you a question. When was the last time somebody on this screen went onto a website and the website asked your consent for something and you said no? Does that work?
Ago. Or
Sorry?
5 minutes before the lecture started.
Okay. So it happens sometimes, but the opt-in model is bankrupt. Most users...
The thing is, legacy players have that information already and they are using it. So whether we open it up for competition or not, that is the question right now.
I beg to differ. I think they have much of our transaction data. They have the amount of money that we're buying, that we're spending, and so on. They don't have sniffers. They don't know where I'm consuming information. They don't know which websites I'm visiting. They don't know where I'm traveling because they have access to the GPS coordinates in my phone. So it's a matter
of course, what I mean is they have financial data on us and they're using it. And the question is, do we open it up for competition or do we allow them to still have it like a monopoly?
Right. So maybe you say yes to open banking, but no to location-based information for financial services. I don't know. I mean, these are questions that are very real and active, and regulators across the world certainly have an eye on it. And we also talk to each other internationally about these topics. We are now out of time. So I'm glad we got through lecture 2 in 2 parts. And I will see you all in 2 weeks when we talk about digital currencies. Thank you for attending.
Thank you very much, Oded.
Have a good evening. Bye-bye.